Imagine waking up to a world-shaking headline that feels straight out of a science fiction novel. A digital token, created just a little over 1 decade ago by a handful of technologists and visionaries, now boasts a market value greater than Royal Dutch Shell, a titan of the oil industry whose roots stretch back over a full century. For generations, companies like Shell have been the beating heart of the global economy. Their fortunes, built on a foundation of sprawling oil fields, endless pipelines, and vast refineries that reach into nearly every corner of the planet. These companies did not just fuel cars or heat homes, they powered entire economies, shaped geopolitics, and even altered the fate of nations. Yet now, in a plot twist that would have been laughed off as fantasy just a few short years ago, Ripple's XRP, a cryptocurrency once dismissed as an obscure experiment, has officially surpassed Shell in market capitalization. This moment has sent shockwaves, no pun intended, through both financial markets and energy circles, igniting an intense debate about the future of money, the nature of value, and who will wield real economic power in the decades to come. To understand how we arrived at this astonishing crossroads, it helps to journey back through the history of value itself. For centuries, tangible commodities like gold, silver, and especially oil were the anchors of economic supremacy. The 20th century, often dubbed the Age of Petroleum, was defined by the rise and fall of oil prices. Nations and empires prospered or withered based on their access to black gold. Royal Dutch Shell, founded in the early years of the 20th century, became a global behemoth, operating in over 70 countries and, in 2024 alone, raking in annual revenues that soared well beyond $284 billion United States dollars. Shell didn't just sell oil, it moved armies, shaped treaties, and helped build the industrial backbone of the modern world. From the boardrooms of London and The Hague to the sun-scorched deserts of the Middle East and the rain-drenched coasts of West Africa, Shell's influence was inescapable. Now, set that legacy beside Ripple's XRP. Born in the digital wilds of the early 2010s, XRP was never intended to power machinery or warm homes. Instead, its mission was to move value itself, instantly, seamlessly, and across borders. Ripple Labs, the company behind XRP, recognized that the global financial system was plagued with inefficiencies. International wire transfers could drag on for days, bleed away value through exorbitant fees, and were all too often susceptible to mistakes or fraud. Ripple's answer? A decentralized blockchain called the XRP ledger, designed to process up to 1,500 transactions per second. By comparison, traditional networks like SWIFT typically take 2 or even 3 business days to settle cross-border transactions. XRP's promise of near-instant, low-cost global payments was a game-changer, one that quickly caught the attention of both nimble fintech startups and cautious, well-established banks. Since July of 2024, XRP has experienced a meteoric ascent. Its price has skyrocketed by more than 500%, catapulting from under 60 cents to a record high of $3.65. But this is not merely a tale of speculative mania. On a single day in mid-July, the XRP ledger saw over 10,000 new accounts spring to life, a clear sign that adoption is spreading far beyond a niche circle of crypto enthusiasts. The total value locked on the XRP network has smashed through 92 million United States dollars. So-called whale transactions, those involving over 210 million XRP in a single move, sometimes valued at more than 730 million United States dollars, are now routine. Behind these mind-boggling numbers are not just retail investors, but institutional giants. Major global banks, hedge funds, and even central banks quietly building positions, perhaps hedging against a future where digital assets are as essential as oil once was. But why has this seismic shift happened now? Several powerful forces have converged to make this moment possible. First, the world of finance is undergoing its most profound transformation since the invention of double-entry accounting. Blockchain technology, once dismissed as a playground for rebellious coders and dreamers, now sits at the heart of global financial innovation. Cryptocurrencies, once sneered at as bubbles waiting to burst, are rapidly evolving into critical infrastructure. XRP, purpose-built as a bridge currency for banks and payment providers, stands out in the crowded field of digital tokens. Its integration into payment rails from Asia to Europe to the Americas has given it a legitimacy few other cryptocurrencies can claim, drawing the gaze and the capital of institutional heavyweights. Second, regulatory clarity is finally beginning to emerge in key markets. After years of uncertainty, Governments and regulators are developing frameworks that recognize the unique features of blockchain assets, while working to safeguard consumers and ensure the stability of financial systems. This new regulatory landscape has unleashed a tidal wave of institutional capital. Hedge funds, pension funds, and even family offices now see XRP as more than a high-risk gamble. They see a utility with staying power. As more institutions come to appreciate that XRP's value derives not just from speculation, but from its fundamental role in efficiently moving money across borders, its position in the global hierarchy grows ever stronger. Yet every revolution brings its own set of challenges, and the rise of XRP is no exception. Detractors are becoming more vocal. Coin Bureau, a respected voice in the crypto community, recently declared, "Crypto is now outpacing big oil." But is this breathtaking ascent truly sustainable? Finance expert Rajat Soni has flagged serious concerns about XRP's ownership structure. According to multiple analyses, a relatively small number of wallets control a disproportionate share of the total XRP supply. This concentration raises troubling questions about the potential for price manipulation and undermines claims of true decentralization, a persistent issue across the crypto landscape. If a handful of whales can move markets with a single transaction, how robust is this new financial order? Meanwhile, Shell and the broader oil industry are hardly fading away quietly. Shell remains a global powerhouse, generating net income of over $16.5 billion last year and commanding infrastructure that spans more than 70 countries. Its tangible impact, from fueling the world's shipping fleets and aviation industry to powering entire metropolises, remains unmatched by any digital asset. More than 1.5 billion people around the world continue to rely on fossil fuels for daily life. Shell's future, while challenged by the accelerating energy transition and mounting climate pressures, is far from sealed. Some analysts even predict that a sharp uptick in oil prices, or a government-driven shift back to traditional energy sources amid geopolitical turmoil, could trigger a powerful resurgence for the sector. So what does it really mean when a cryptocurrency overtakes a century-old oil titan in market capitalization? Are we witnessing the dawn of a new economic era, where digital assets routinely eclipse the industrial giants that built our modern civilization? Or is this simply the latest speculative bubble, inflated by easy money and destined to burst as quickly as it rose? The answer is anything but simple, and the implications are enormous for investors, policymakers, and everyday citizens alike. Consider the looming prospect of an XRP spot exchange-traded fund, or ETF. Analysts estimate that the odds of regulatory approval are as high as 93%. Should such a fund gain the green light from major watchdogs, it could open the floodgates to institutional investment on a scale the crypto world has never experienced. Rob Cunningham, a respected blockchain researcher, believes that new institutional inflows could propel XRP's price to dizzying heights, 20 or even 30 United States dollars in the coming years. Such levels would have sounded like science fiction just a year ago. The approval of an ETF would not only cement XRP's status among the world's most valuable assets, but could spark a paradigm shift in how society defines and recognizes value itself. Yet, this scenario is far from guaranteed. The risks are as real and immediate as the opportunities. The ongoing legal battle between Ripple and the United States Securities and Exchange Commission continues to cast a long, uncertain shadow over XRP's future. If the courts rule against Ripple, or if regulators in other major economies adopt a hostile stance, the resulting uncertainty could stall adoption and erase much of XRP's recent gains. Moreover, the very technology that powers XRP, while robust and efficient, remains susceptible to unforeseen bugs, network attacks, or contentious governance disputes. The history of digital assets over the past decade has made one thing clear. No token, no matter how innovative, is immune to volatility or systemic risk. It is instructive to look to the past for guidance. In the early 20th century, as oil first flooded global markets, few could have imagined that the fledgling automobile and aviation industries would one day upend the world's economic order. Railroads, which once dominated capital markets and seemed untouchable, were gradually overshadowed by oil, automobiles, and eventually the rise of information technology. Each era's dominant asset class has given way to the next wave of innovation. Today, as data becomes the world's most precious commodity and code replaces concrete as the bedrock of value, XRP's rise may be a signal of an even more radical transformation just beginning to unfold. For the average person, whether you are a cautious investor, a technology enthusiast, or simply someone curious about the future, The rise of XRP over Shell is much more than a headline. It is a powerful signal that the foundations of economic value are shifting beneath our feet. Where once factories, mines, and oil fields defined wealth, today it is increasingly about algorithms, networks, and the ability to move value at the speed of light. This is not just a technical shift, it is a philosophical one, raising profound questions about trust, the role of central authorities, and how value is created and distributed in a hyper-connected world. Let's dig deeper into the practical implications of this sea change. First, never underestimate the speed of disruption. Just 12 months ago, almost no one predicted a 500% rally for XRP, or its meteoric ascent into the ranks of the top 3 cryptocurrencies by market capitalization, trailing only Bitcoin and Ethereum. This rapid shift underscores the importance of agility in both investment and mindset. Second, look beneath the surface of price charts. In the digital age, true value is rooted in utility. How widely a technology is used, how deeply it is trusted, and how effectively it solves real-world problems. Price is only the tip of the iceberg. Beneath it lies the adoption curve, the evolving regulatory environment, and the fundamental strength of the underlying technology. Third, stay vigilant about regulation and policy. The rules being drafted today in Washington, Brussels, Beijing, and other power centers will determine which digital assets thrive and which fade away. The outcome of the Ripple versus SEC case, for instance, could establish legal precedents that shape the destiny of every blockchain project for years to come. Whether you are an investor, developer, or business leader, keeping a close watch on regulatory developments is essential. Fourth, be acutely aware of the risks. The concentration of XRP ownership means that a handful of large holders can, in theory, move the market in dramatic ways. While this is not unique to XRP, Bitcoin and Ethereum face similar challenges. It does mean that volatility and sudden price swings are likely to be a permanent feature of the landscape for some time. For those with a low tolerance for risk, caution is advised. Fifth, consider the broader social and economic implications. As XRP and other digital assets become woven into the fabric of global finance, they create new opportunities for financial inclusion, cross-border commerce, and remittances. In regions where access to traditional banking is limited, cryptocurrencies like XRP have already become lifelines, enabling individuals and businesses to send and receive money instantly, securely, and at minimal cost. This is not theoretical. It is happening right now in parts of Latin America, Africa, and Southeast Asia, where digital wallets and blockchain-based services are leapfrogging legacy financial systems. But with all this promise come a host of unanswered questions. Can digital assets truly replace the physical infrastructure that underpins modern civilization? Oil is not just about energy. It is a raw material for everything from plastics and fertilizers to pharmaceuticals. Can a string of code, no matter how sophisticated, ever wield the same tangible power? Or are we heading toward a hybrid future, where digital and physical assets coexist in a complex, interdependent dance? Let's not overlook the environmental dimension of this transformation. The oil industry, for all its contributions to economic development, is a major driver of climate change. Shell and its peers are under mounting pressure from investors, regulators, and activists to decarbonize, invest in renewables, and reinvent themselves for a low-carbon era. In contrast, the environmental impact of cryptocurrencies is fiercely debated. While Bitcoin has drawn criticism for its energy-guzzling proof-of-work mining process, XRP's consensus protocol is far more efficient, consuming only a tiny fraction of the energy required by proof-of-work blockchains. This energy efficiency has become a central selling point for institutions seeking to balance innovation with sustainability, and could prove decisive as environmental, social, and governance criteria take center stage in global finance. Behind the scenes, a quiet revolution is unfolding. Some central banks are discreetly experimenting with XRP's blockchain for cross-border settlements, even if they have not yet made these pilots public. Should these experiments prove successful, we could see the integration of XRP or similar technologies into the very plumbing of the global financial system. In other words, the digital revolution is not just coming, it is already being woven into the fabric of how money and value move around the world. Looking to the horizon, the future remains tantalizingly open. Will XRP's reign at the top be brief? Or will it mark the beginning of a new era where digital tokens become the world's most prized assets? The answer depends on an array of unpredictable factors. The outcomes of regulatory showdowns, the pace of technological breakthroughs, the ebbs and flows of global markets, the evolution of public trust, and the willingness of societies to embrace new models of value. What is certain is that we are witnessing a transformation as profound as the shift from steam to electricity, or from landlines to mobile phones. For those navigating this uncharted territory, here are a few final thoughts and practical guidelines. Stay curious. Make a habit of reading widely and deeply, drawing insights from both enthusiasts and skeptics. Diversify your knowledge, just as you would diversify your investments. The old rules are being rewritten in real time, and those who adapt quickly will be best positioned to thrive in the new order. Furthermore, it is important for individuals, businesses, and policymakers to remain proactive rather than reactive. The speed at which technological shifts occur today is unprecedented. Companies that once dominated for a century can be overtaken in a matter of years or even months by nimble, innovative challengers. This means that lifelong learning and adaptability are not just buzzwords. They are survival strategies in the digital economy. So, as XRP stands today atop shell in the rankings of global market capitalization, we are left with a provocative question. Has digital value truly overtaken the power of physical assets? Or is this dramatic moment simply a flare in the ever-changing landscape of global markets? Is this the end of one era and the birth of another? Or just a brief interlude before the next chapter in the centuries-long story of innovation, competition, and adaptation? Let us turn the spotlight to you, our viewers. What do you think? Has the balance of power genuinely shifted from oil rigs and pipelines to code and consensus algorithms? Or is this just a fleeting moment, soon to be overtaken by the next big thing? Share your thoughts and perspectives in the comments below. We are eager to hear your insights and experiences. And if you found this deep dive analysis enlightening, do not forget to like, subscribe, and turn on notifications so you never miss an episode. Join us next time as we continue to explore the forces that are reshaping the future of money, technology, and global